Report. The hidden realities of margin risk in cash-secured put strategies. 1. The modern landscape of cash-secured puts, CSPs. The traditional cash-secured put, CSP, has evolved from a simple capital preservation tool into a sophisticated income generation strategy. By selling a put option while maintaining sufficient collateral to purchase the underlying shares, investors seek to monetize time decay and volatility. Current brokerage architectures, particularly those of Fidelity, Robinhood, and Vanguard, have introduced a yield-on-yield effect where the collateral itself resides in interest-bearing instruments. Primary benefits identified in current market operations include income enhancement, collecting option premiums while simultaneously earning interest on the underlying collateral, e.g., Fidelity's SPAC's money market sweep or Vanguard's similar interest-bearer core positions. Sideways market monetization, generating positive returns in neutral or slightly bearish environments where the underlying asset price remains above the strike price. Targeted share acquisition, utilizing the wheel strategy to acquire shares at a predetermined, lower price point, effectively being paid to wait for an optimal entry. 2. The silent margin trap, shifting collateral architectures. A critical risk transition has occurred as brokerages move away from static/transparent collateral models toward dynamic/opaque architectures. As noted in the Wedeter 2026 analysis, the modern model often lacks explicit cash segregation, leading to a silent trap, where trades intended to be cash-covered inadvertently utilize margin. Static versus dynamic collateral management. Static/transparent model, traditional. Dynamic/opaque model, modern. Fixed segregation. Cash is explicitly locked or held in a dedicated, visible bucket for the specific option contract. General pool utilization. Cash remains in a general margin pool. Requirements fluctuate based on broader portfolio volatility and internal risk models. High visibility. Actual buying power is easily calculated as a simple subtraction from the cash balance. Opacity and warning levels. Visibility is low. Internal warning levels and proprietary risk metrics determine buying power without a clear way to segregate specific funds. Requirement stability. Margin and collateral requirements are fixed and clearly defined at the time of trade entry. Volatility-driven flux. Requirements shift in real time. A sudden spike in volatility can cause collateral requirements to jump, potentially triggering stealth margin usage. 3. Mechanics of unexpected borrowing interest. The lack of explicit cash segregation creates a pathway for a cash-secured trade to become a margin leverage position without the trader's awareness. This results in the following sequence. General equity pooling. The broker evaluates total account equity rather than the specific cash amount the trader intended to allocate to the put. Sudden volatility spikes. Market fluctuations or spikes in implied volatility cause the broker's internal risk models to increase the margin requirement for the short put. Unintentional margin debit. If other trades utilize available cash, or if the new requirement exceeds settled cash, the account enters a margin debit. Quiet erosion of balance. Because these small debits often do not trigger a formal margin call, the broker simply charges borrowing interest. These fees are quiet and not always obvious, directly eroding the premium income and reducing the net strategy return. 4. Broker-specific policy analysis. 4.1 E-Trade. Levels and authorization requirements. E-Trade employs a tiered approval system for options, with specific compliance requirements for organizational accounts. Level 2. Standard cash-secured puts, CSPs, and long call/puts. Level 3. Spreads and naked puts, margin secured. Level 4. Naked calls, uncovered writing, requiring the highest risk tolerance. For business entities, LLCs, corporations, E-Trade requires a certificate of secretary. This document must certify that the charter and governing laws permit margin and options. Critically, it must certify that the signatures appearing in Section 10 of the application are authorized to bind the applicant. Furthermore, more than half of the governing body, defined as board members, officers, partners, or owners, must provide their details and signatures to authorize agents for the account. 4.2 Comparative architecture. E-Trade versus peers. Broker. Collateral type, cash/margin. Interest on collateral. Approval ease. Liquidation policy. E-Trade. Margin secured, level 3+. Bank sweep, ESDA. Stringent, level 4 rare. May liquidate without notice. Fidelity. Cash, MF/SPACs. 5% core position. Moderate. Standard margin call. Robinhood. Cash/stock. 3.35% APY, gold only. High. Automated liquidation. IBKR. Margin, rule-based. For 0.5%, only greater than $10,000. Moderate. Real-time liquidation. 5. Regulatory framework. FINRA Rule 4210 and Reg T. 5.1 Updated interpretations, August 2024. As of August 9th, 2024, FINRA has clarified key definitions under Rule 4210. Good faith margin, defined as the amount a creditor requires by exercising sound credit judgment. Creditors must be alert to circumstances and investigate certifications that appear incorrect to a prudent person. Definition of customer now explicitly includes a counterparty to a reverse repurchase transaction other than an exempted borrower. These are treated as margin loans against a long position in the purchase securities. 5.2 Reg T versus portfolio margin. Regulation T. Reg T, a rule-based system using fixed percentages, typically 50% for initial stock purchases. It relies on formula-based margin for options and utilizes a special memorandum account, SMA, for overnight power. Portfolio margin, PM, a risk-based stress test approach. 15% movement requirement. The PM requirement is the largest theoretical loss if the underlying asset moves plus or minus 15%. Calculation granularity. For equities, this range is divided into 10 equidistant points. For broad-based indexes, SPX/NDX, it is divided into 20 equidistant points to capture more precise risk arrays. While PM allows for greater capital efficiency, it carries significantly higher liquidation risk due to shorter T+2 deficiency resolution windows. 6. Risks of uncovered options writing. Trade's official documentation regarding higher-level options emphasizes the asymmetric risk profile of these strategies. The potential loss of uncovered call writing is unlimited. The writer of an uncovered call is in an extremely risky position. The risk of writing uncovered put options is substantial. If the value of the underlying instrument moves against an uncovered writer's options position, the investor's broker may request significant additional margin payments. If an investor does not make such margin payments, the broker may liquidate stock or options positions in the investor's account with little or no prior notice. 7. The IBKR and Robinhood anomalies. 7.1 Interactive brokers, real-time liquidation. IBKR operates a strict no-margin call policy. Monitoring is performed in real time. If equity falls below maintenance requirements, the system liquidates positions immediately. While IBKR may attempt to send notifications on a best efforts basis, they are not required to do so, and market speed often renders these notifications impossible before liquidation occurs. 7.2 Robinhood. Gold versus standard collateral. Robinhood Gold subscribers earn a 3.35% APY on settled cash held as options collateral. This is calculated based on the settled balance from the previous trading day. Crucially, this interest accrual excludes intraday trades, positions opened and closed on the same day, which do not count toward the settled balance for interest purposes. 8. Risk mitigation. Practical safeguards for traders. To manage the risks of dynamic margin environments, traders should move beyond dashboard metrics and adopt institutional-grade risk buffers. Risk compliance checklist. Establish a safety buffer. Never utilize 100% of buying power. Limit entries to 60 to 70% of displayed capacity to absorb volatility-induced requirement spikes. Review daily margin reports. Proactively monitor buried daily margin reports to identify position-specific requirements and internal warning levels. Verify corporate authorization. For business accounts, ensure the certificate of secretary explicitly authorizes margin/options and includes all required signatures of authorized persons. Monitor IBKR Excess Liquidity. Ensure excess liquidity and SMA values remain positive in TWS to avoid immediate, automated liquidations. Anticipate trade restrictions. Be aware that brokers may freeze new entries or restrict account activity during high-volatility events to protect collateral levels. Confirm cash segregation. Explicitly verify if your broker locks cash for puts or pools it. If the latter, anticipate stealth interest charges on margin debits. Related resources. The Silent Trap of PDT of 2026, How to Start a Newsletter, Local AI versus Cloud AI, Best AI Tools for Beginners, Best Local AI Tools, How I Use AI, Self-Publishing Basics, AI, Tools, Business Tools, Publishing Tools, Websites, Worth Bookmarking Report, Margin Risk on Cash Secured Puts. Wedeter. We determine what connects. Explore. Home AI and Technology Business and Money Books and Publishing Resources. Quick links. About Privacy Policy Terms of Use Contact. Copyright 2026 Wedeter.com. We determine what connects.